we're delighted to welcome today Andreas Schrimpf from the Bank of International Settlements to speak to us today. Andreas is the head of the Financial Markets Unit and Monetary Econ Department at the BIS. He's had a stellar career there, but a career also that spans important academic contributions in terms of publications in various areas, various markets, various different types of asset prices. And in recent times, has been doing a lot of work, in particular market microstructure and intermediation. Given there are various debates related to how markets might function as monetary policy normalizes, it's good to have any sort of discussion about dealer constraints. And so I give the floor over to Andreas. You've got about 45 to 50 minutes to speak. Throughout, if people have any questions, please add them to the Q&A. I'll monitor those. I might defer them till the end, but if they're sort of immediately relevant, I may interrupt and put them to Andreas immediately. So Andreas, please take it away. We're delighted to have you.
Yeah, thank you very much, Reese, for this kind invitation. It's a great pleasure to present today. The title of the talk that I'm going to give is Constraint Dealers and Market Efficiency. And that's some joint work that I've been doing together with my colleague Wenchan Wang, and then Angelo Ronaldo and Fabrizio Somoghi, who are both at St. Gallen University. Also, before I get going with the presentation, just the usual disclaimer that any views that I express in this talk are my own and not necessarily those of the BAS. So let me start with a little bit of background for this research. So here on this slide, what I'm showing is data from the flow of funds in the US, looking at the evolution in total assets in various key sectors in the economy. We're especially focused on the blue line here, which is showing you the broker-dealer sector in the US. But also I'm showing various other key sectors, in particular commercial banks, non-financial corporates, and then also households. What you can see here on that slide is really basically the massive growth in the broker-dealer sector, starting around the mid-70s or so. Really spectacular growth that led to a massive increase in the total assets of this sector, pretty much until prior the great financial crisis of 08 and 09. Then we saw a significant drop. And then also what you can see is essentially a relatively stagnant growth of that sector compared to the other key sectors that are also in the flow of funds. If we're looking at leverage in the broker-dealer sector, we see also a significant rise in leverage here as expressed as assets over equity in the run-up to the financial crisis of 08 and 09. So the key point here is that leverage is heavily supporting the growth of the broker-dealer sector in the run-up to the GFC. And given the fact that the dealers are the major market intermediaries, it's essentially meaning that leverage is heavily supporting their liquidity provision. Now, what we've seen in 08 and 09, you can see it in the shaded gray area, is that there has been a massive deleveraging of the sector. And ever since then, also, not least given the re-regulation of the banking system post-GFC, we've seen leverage becoming much smaller over time. So overall, the broker-dealer sector has much less of a heft in the financial system than it used to have. Market activity has gravitated also more towards other parts of the financial system, and intermediation has shifted to other key players. Some of them are non-banks. But I think it's fair to say that constraints on dealers' risk-bearing capacity, both from an internal perspective due to risk limits and risk constraints, but then also due to the re-regulation of the banking system, that they have gotten now a much more important impact on the general liquidity in financial markets. So against that background, big picture-wise, what's the main research question of our paper? So what we seek to answer in this paper is to address the question, to what extent dealer constraints adversely affect market efficiency? And I will later be very specific about what I mean by market efficiency, because obviously there are many different definitions and many different meanings attached to market efficiency. But really key to our research is that we think of financial intermediaries playing a crucial role in supporting that market efficiency. And this is especially the case for markets that are traded over the counter, and are not all-to-all markets, but that essentially have a decentralized market structure, i.e. not organized as centralized exchanges. One key market that is traded OTC, that's the foreign exchange market. And it's essentially a very good laboratory for our work, because it is the largest of the OTC markets, and presumably also the most liquid market out there. I should say at the beginning that we're focusing on the spot market segment, and we're not looking at other very interesting segments such as forwards, options, or swaps. But as I said, it's the research is focused on the spot market. But also, like other OTC markets, the FX spot market works in a decentralized manner and predominantly trades OTC. So we think it's a very good laboratory for understanding the impact of dealer constraints on market efficiency. Let me now turn or give you a bit of a nutshell of what we're essentially doing in the paper and what we're finding, what essentially the main contribution is. So we have two main parts of the work in the paper. The first one is an empirical investigation of the role of dealer constraints on market efficiency, and this is really, I would say, the core of the paper. So in this part, we're providing a coherent analytical framework to measure market efficiency in spot FX markets. That's the first key thing that we do. We propose a new measure on how to approach the question of measurement of market efficiency. And then we analyze dealer constraints and to what extent they have a bearing on market efficiency. And we find that in normal times, when dealers are unconstrained, their liquidity provision helps to support market efficiency. But when dealer constraints tighten, and I will lay this out much more in depth throughout the presentation, what I mean by that, then the elasticity of their liquidity provision weakens. And then once we have established these empirical results, we then provide a theoretical model of constrained FX liquidity provision that helps us rationalize these empirical findings. Here we draw on a fairly standard partial equilibrium model, as is common in the microstructure literature. And in particular, the key focus there of that model will be on the correlation of the intermediate volume by the dealers and measures of price inefficiency. So we're looking at the state-dependent correlation between these two objects and how that correlation changes with dealer constraints. Let me give you a brief overview of how the paper fits into the literature. So we believe we make progress in three key areas in the literature. The first is the literature on intermediary asset pricing, which has seen really a massive growth very much since the GFC, with a lot of important contributions as listed here on this slide. So to this literature, our paper offers a new perspective, in particular, I would say, focusing also on the role of quantities, in particular, intermediated volume of transactions, which has typically not been studied before in this literature. And a key point of our paper being that when financial intermediaries are constrained, that their liquidity provision does not keep a pace with the liquidity demand. Then the second area that we're contributing to is the literature on limits to arbitrage. That's a clearly an older literature with a lot of work, in particular also starting from Schleifer and Vishny back in the 90s, etc. Several papers in this literature have found there to be commonalities as well in the limits to arbitrage. So a few of them are listed down here on the slide. And in this regard, our paper also contributes by highlighting in particular the role of intermediary constraints as a driver of such arbitrage commonalities. And then third is the broad literature on FX market microstructure and trading volume. I would say here the focus has typically been a bit less on trading volume itself, but there are a few exemptions recently that are listed down here below. So just to give an example, from Hasbrook and Levitch, they have a bunch of recent papers where they're looking at CLS volume data, or also Cespa, Gargano, Riggio, and Sarno. They're looking at CLS settlement volume data. And then also recent work by my co-authors, Angelo Ronaldo and Fabrizio Somoghi, that has been looking at trading volume data. So with this, let me move on to the empirical analysis that we're doing in the paper, unless there are any questions. So let me just quickly pause to see if there are any questions.
No questions yet, but I'll keep my eye out.
Thank you, Rhys. So let me now turn to what we're a little bit more specifically what we're doing in the paper. As I mentioned or alluded before, we're relying on information on trading volume that comes from CLS. CLS, for those that don't know it, is really, I would say, a crucial infrastructure, so to speak, an extremely important utility in the financial system, because it helps alleviate settlement risk in FX transactions. And it does so by providing the largest payment versus payment settlement system in the world, and handles a very large chunk of the total FX flows that are happening every day. And we know that these are extremely big, to the tune of about $6 trillion per day. So the amount of settlement risk that is reduced through CLS is very big. And what's unique about that data is that essentially it really provides us with really an aggregate view on the market, which otherwise would be very difficult to achieve because of the very decentralized and fragmented nature of FX trading. So we essentially from CLS get hourly data on spot volume and order flow, but we will aggregate this data up to lower frequencies for our analysis in the paper. And then we combine the CLS data with data from another data provider, Olsen Financial Technologies, where we get minute by minute bid and ask quotes for the main FX crosses. Our time period runs from November 2011 to September 2020. And so we're capturing a good chunk of this period where the main re-regulation of the banking system happened. And essentially, we're capturing the new normal, I would say, of liquidity conditions and markets post-GFC. In terms of the exchange rates that we're covering, we're quite limited by the availability on CLS. CLS covers the most liquid currencies around the world, plus a few of the liquid emerging market currencies. And so overall, we have 10 dollar-based currency pairs, and 15 non-dollar currency pairs in our sample. So let me now turn to how we measure market inefficiency in the FX spot market. What we do in the paper is we take the perspective of an arbitrageur that looks at the triangular arbitrage between dollar and non-dollar currency pairs. So just here as an example, a non-dollar cross, for example, that could be traded is the exchange rate between the euro and the Canadian dollar. Whereas then we have the respective currencies, both the euro and the Canadian dollar also being traded against the US dollar. So it's really been a quite classical trade, typically for FX spot traders to focus on this triangular arbitrage relationship between these three crosses. And then the measure that we derive, it captures two important dimensions of efficiency, I would say. The first is the efficiency when it comes to prices. So the idea is essentially that in an efficient market, the price should be unique and reflect fundamental information, such that also prices can perform their important allocative function properly in the market and also beyond in the economy. So that's what I mean by price efficiency. But the measure also captures another important dimension, which is liquidity conditions, and associated with that, the limits to arbitrage, because it also has a strong component that links to trading costs, that creates some no arbitrage boundaries. And you will see this in a couple of minutes when I show you the equations for the efficiency metric that we're proposing. This measure we call the price inefficiency metric, or PIM. So I will use PIM from now on quite frequently. It is exactly this measure that is called the price inefficiency metric. Now, just a quick example of the main ideas behind this measure. So here we're showing on the left hand the triangle between for these three currencies that I mentioned in the example: the euro, the US dollar, and the Canadian dollar. And the trading approach is very simple. So it essentially consists of a round trip where a trader starts, let's say, with €1, then exchanges that against US dollar at the prevailing exchange rate, and then continues to exchange these corresponding dollars to the Canadian dollar, and then exchanges it back to the euro. And in this example here, which is just really arbitrary numbers, that trade would yield a very small profit of 1.8% in this case. Now, however, of course, in the real world, the trader would not face mid quotes when trading, so it's important to take into account the bid-ask spreads, right? So, and that's what we're doing here on the next slide, where all these transactions that the trader needs to do in the round trip, they take place not at the mid quote, but at the less favorable prices. That is here for these for the selling of the respective currencies, it would take place at the bid price, at the respective bid prices. And what you can see here is, in this particular example, again, very arbitrary example and numbers. The transaction costs involved would be so big so as to make this round trip of transactions generating a loss for the trader. And so we would end up with less euros than the one that we started with. Now, how does this map into the price inefficiency metric? The price inefficiency metric essentially captures these two key components of inefficiency that I mentioned before. So price efficiency and trading cost. And it builds on these payoffs from the triangular arbitrage, delta t, then we're taking the log, and then we can decompose this object into a part that's related to violations of the law of one price. That's the left-hand side here of the equation 1. And then we exploit a basic fact that mid quotes are that bid and ask quotes, they can be expressed as essentially the mid quote plus or minus the respective half spread, and so then we can essentially have this second component here, which is called T cost in our case. And VLOOP and PIM essentially captures these two key components. So it is built based on VLOOP whenever VLOOP is greater than 0, and then we add the absolute of the cumulative trading costs to restore the no arbitrage relation. We're adding that on top. So it essentially consists of these two main components: law of one price deviations, and then trading costs to restore these price dislocations. Now, how about dealer constraints? So when it comes to dealer constraints, what we do is we look at various measures that we can obtain for individual financial institutions. In particular, we're looking at a very widely available industry survey of FX dealing, of FX dealers and their trading volumes from Euromoney, and look at how the market shares of these FX dealers changes over time. These would be institutions like JP Morgan, Citibank, Barclays, etc. And for these individual institutions, we observe their value at risk, their leverage ratio, credit default premium or CDS, and we also have a measure of their debt funding cost based on bond issuance. And then what we do is we weight these measures together based on the market shares that these dealers have in global FX trading. And then we add another component to it, which is just simply a version of the VIX for the currency market, which is coming from JP Morgan. So this is the fifth ingredient into our constraint measure. And then once we have these 5 metrics available to us, then we perform a simple principal component analysis of these 5 measures, which then measures how dealer constraints fluctuate over time in the aggregate. And due to the fact that there are multiple ingredients in this measure, we believe, it captures various dimensions of dealer banks' risk-bearing capacity.
Andreas, can I ask just a quick question?
Sure.
All of those 5 variables make sense. Just the fifth, I just feel that maybe it's not quite like the rest of them. It's almost a little bit sort of circular. The previous 4 look very much like sort of some of it's balance sheet space or health, but then the fifth is almost like something you're trying to possibly explain as an outcome, possibly. Just maybe you want to comment on that. I can see sort of why it's there, but just given how delicate everything is in this paper, I thought maybe you might want to comment on that.
Yeah, it's a good point. It is indeed a little bit like odd, maybe, let's say, how compared to the others. Still it captures similarly as some of the others constraints that are related to, I would say, value at risk. So whenever this VIX spikes for the FX spot market, we should see much more internal risk limits biting and constraints on inventories biting, etc. But I agree with you that these that it's maybe not a measure that sort of like links very closely to. It
seems less of a primitive. It seems less of a primitive relative to the story you're telling, but I can sort of see why it's there.
But you will see also later that when we conduct this analysis on an individual basis, when we use disaggregated measures, it doesn't really hinge on the presence of the.
Cool. Thanks very much.
Okay. Thank you. You see here on this chart just how these fluctuate over time, these measures. Key point here is that there is just really a large amount of commonality in these measures. I should have also said that some of them, like the VAR measures and also the leverage ratio measures, we're not observing them on a daily frequency, but they come in at a quarterly frequency into the measure, which is a little bit unfortunate, but still, even despite that, we see a lot of commonality in these variables, which is quite comforting for our analysis, I would say. Okay, so let's now look at the first cut of the data in order to better understand the link between our price inefficiency measures and the dealer constraints. So here in this slide, which is just some basic descriptive analysis, first we're looking at essentially a movement along the distribution of the dealer constraint measure. So with the 10 percentile in the upper row being the least constrained reading of the dealer constraint measure, and then the lower row of the table being the most constrained when we're in the 90th percentile of the DCM distribution. And so maybe we can focus first on the column when it comes to volatility, which is the second to the right. So we see clearly that when we move to the more constrained regimes, volatility tends to pick up. This is realized volatility. Then we see in the column for volume that dealer intermediated volume tends to also rise when we move from least constrained to more constrained. And then we see also that the price inefficiency metric itself is rising when we're going from unconstrained to more constrained regimes, and it does so in a monotonic fashion, whereas it in the other cases not always monotonic, but we also see a rise. Now I would also like to draw your attention to the correlation between the price inefficiency metric and intermediated volume, which is a key object that interests us in the paper, both empirically and theoretically. And we see that typically in the unconstrained regimes, we see a relatively good correspondence. So whenever PIM is high, also volume seems to be good. So there's a lot of intermediation and liquidity provision. But when the dealers become more constrained as we move to the 90th percentile, this correlation between inefficiency and volume shrinks. And we look at this now in much more depth in the following, because this is going to be really key for the analysis. Let me just skip this one here and turn now to basically this state-dependent relation between efficiency or inefficiency and dealer intermediated volume. As the table previously showed, so we have this initial finding that market efficiency tends to deteriorate when dealers are more constrained, as captured out by our DCM variable. And we also have this finding of the correlation between PIM and volume essentially weakening when we're in more constrained states for the dealers. Regarding the latter, one interpretation here is that while the intermediated volume by dealers goes up in these constrained states, this rise in volume is simply not enough to keep the rise in inefficiency in check that happens in parallel. So in essence, the elasticity of liquidity provision weakens when dealers become more constrained. And this is what we want to now investigate further. And what we do is we move to models that capture the state-dependent relation between PIM and volume. Our key focus here is on the so-called smooth transition regression model. But we also established this result with some simple dummy variable model as well. So let me just pause to see if there are any more questions at this stage.
We answered a couple offline. One of your co-authors is a panelist, so we've dealt with a couple, but we might come back to them at the end if that's okay as well.
Excellent. Yeah. So hi, Fabricius. I can't see you, but feel free to answer questions on my behalf.
Absolutely.
All right. So then let's turn to the main equations that we're estimating. So here, first is the linear model with a dummy variable. This is just very simple. We're having here the regression of PIM on our main intermediate volume measure, but then we're also interacting the intermediate volume measure based on a dummy variable that captures when we're in the states of heightened dealer constraints. We also have time series fixed effects and currency pair triplet fixed effects in these regressions. And also, as a control variable, we include realized volatility. Note that we're running these regressions in changes, so in log changes. So all of these variables are in log changes. So however, the main regression equation that we're estimating is the one given by equation 4 here down there, which is based on the so-called smooth transition regression model, where we are essentially capturing changes in the effect depending on a regime that is governed by the logistic function G, which in turn depends on a state variable that is lagged, Z. And this lagged state variable is essentially the dealer constraint measure that I outlined earlier. So what this model does is it allows for smooth changes in the impact of the right-hand side variable and left-hand side variable, depending on the value, the realization of the main state variable, which in our case is the dealer constraint measure. The estimation of this model proceeds with nonlinear least squares and GMM. And what we're really interested in is the impact of the coefficients across the two regimes, with the parameter beta 2 capturing the constrained regime and beta 1 the unconstrained regime. So let me turn to the results of this when we're estimating this for our 15 currency triplets in the data. You can see here that regardless of the methodology, whether it's a dummy or a logistic regression, where we're imposing a smoothing parameter gamma here of 1, or when we also estimate that smoothing parameter, we get pretty consistent results in that the coefficient in the unconstrained regime is always much higher than it is in the constrained regime. So just to give an example here for the L-star model, we have 0.11 for the coefficient in the unconstrained regime versus 0.02 for the constrained regime. And so overall, a significantly higher impact of intermediated volume on PIM in these unconstrained regimes. Also note that the realized variance always comes out significantly in these regressions. And when we are then testing for the difference, whether the difference between the constrained and unconstrained regime, whether there's a difference in the coefficient between these, they're all statistically significant and economically sizable. So what's also interesting is to look at how the regime variable changes over time, because it's quite intuitive as well. So here up there, panel A shows the estimated G function depending on the lagged exogenous dealer constraint measure. And we can see that in particular, in the early part of the sample, we're very much in the constraint regime. Then there's a period when the constraints ease. Some constraints are sort of more intermediate, perhaps around the period of 2015, 2016. And then there was a period of relative calm, unconstrained dealers between 17 until 2020. And then you notice here also the big spike again to a constraint regime in the COVID period and also afterwards. We're also investigating different types of this regression, in particular focusing on the components of the price inefficiency metric. So, looking separately at V-loop versus the transaction cost variable. This is what is contained on this slide here. And we can see that the main effect holds for both variables, both T-cost and V-loop. But from an economic magnitude perspective, the coefficients are larger for V-loop. Actually, we even see a reduction. So essentially a negative coefficient on volume in the PIM regression in the constraint regime, but it's not statistically significant. But overall, the difference between the two coefficients is still statistically significant between unconstrained and the constraint regime, also in the V-loop case. Overall, however, you can also note that the T-cost results, so with T-cost as left-hand side variable, they're overall much more similar to the case of the overall price inefficiency metric variable, which is on the right-hand side for comparison purposes. I guess an important reason there is also that T-cost generally is less noisy than V-loop, which you can see also the R-squares are much higher for the T-cost and the PIM variable compared to the V-loop variable. Okay, so, and then let's turn now to a few additional analyses that we do. As I mentioned to Reese earlier, we also run analysis where we're looking at individual components of the dealer constraint measure rather than the PCA approach. We look at we also look at some disaggregated measures of dealer intermediated volume. We look at a GID approach to alleviate some of the simultaneity issues. And then there are a bunch of other robustness checks that I'm not going to talk about, but let me just focus on 2 or 3 of these first ones. So first of all, here with regard to the disaggregated measures, it's generally a broad picture that's quite similar across the different variables. Indeed, here right-hand side, this VXY variable, that's the FX VIX that we're using as individual state variable here. Actually, the results are, let's say, the weakest for that variable. So only a difference in the coefficients of 0.06 in this case. But generally, overall, the picture qualitatively looks quite similar, irrespective of what variable we're taking into account. We're also, and this is also quite interesting, look at disaggregated volume, where we look at the volume that dealers do with non-bank counterparties on the one hand, versus the volume that dealers do with other banks. And we notice some quite interesting differences in the PIM volume relation, depending on whether it's with banks or non-banks. So generally, we see a much stronger effect for the transactions with other banks. You see the difference between constrained and unconstrained regime tends to be economically much higher for bank intermediated volume, for intermediate volume with regard to other banks. Yeah, the effect is especially strong for the V-loop variable, where it's up to minus 0.19. So that is quite an interesting difference, I would say. And then, so a last check that I wanted to mention to you is that we're using the granular instrumental variable approach that has been recently popularized in the work by Gabet and Coyen. So basically here, the idea is that we exploit some of the granularity in the data. We know that in FX markets, there is a lot of difference between, for example, a relatively important currency like the euro versus let's say the Norwegian krona. So volume-wise, there's just it's just a totally different ball game. And the idea is precisely to follow Gabet and Cohen to construct a GIV variable where we're on the one hand conducting some size weighting of the volume measures, and then we're subtracting an equally weighted volume measure. And by doing so, we're essentially isolating the idiosyncratic rather than systematic shocks. And this is then in turn the variable that we're using as an instrument in our pattern regressions. Just also to give you a bit more intuition about this variable, what's always important when working with this GIV in a GIV setting is that the variable itself makes sense, and some of the big movements can be explained, and that simply they make sense. So here I'm listing the 15 largest readings of the GIV variable, and one can see that they typically link up quite nicely with some of the key events that had been driving markets at the time. So one key one that is one of my favorites is just the Swiss National Bank depegging of the Swiss franc against the euro, which took place on the 15th of January in 2015. But there are many other policy-related events that are also in the data set and that drive the GIV variable. Now, when we then turn to our main regressions where we're using the GIV variable as an instrument, the results are given here on this slide. We see that qualitatively, and please note also here that there are no time series fixed effects in this regression because the GIV variable is common across the different currencies. But overall, you see basically also the same qualitative pattern that the PIM volume relation tends to weaken a lot when we move from an unconstrained dealer regime to a constrained dealer regime. Coefficients are somewhat smaller compared to the baseline results, but still the difference is statistically significant. Now let me turn to a bit of the theoretical part of the paper. So quickly summarizing the empirical findings so as to now. What I've shown is that price inefficiency is higher when volatility picks up and dealers are more constrained, and that volume covaries less with the price inefficiency metric when dealers are more constrained. And so the theory is basically there to give us some intuition as to what main forces are really at play here. And just at the outset, I would like to mention that what will be in particular important is that when they're constrained, the dealers will post more conservative bid and ask spreads, thereby increasing the transaction cost. And this is an important factor in curbing the inventory balance and making the demand less imbalanced. That in turn discourages trading, and so in turn it also leads to a reduction in the V-loop variable, and thereby weakens this relation between PIM and intermediated volume. Okay, so a little bit of further detail. What we're doing is as I mentioned before, we propose a static partial equilibrium model in the microstructure tradition. Liquidity demand is exogenous and modeled in a reduced form. There's nothing really fancy there. What we're focusing on is three currency pairs, X, Y, and Z. We have bid and ask prices, we have the mid quotes, and then we have also the spread, which we denote by S. The law of one price holds for the fundamental values of these currencies. So you see the fundamental values given by E with the superscript for the respective currency X, Y, and Z. Now the model has two key agents. liquidity traders, and there's also a risk-averse dealer. The risk-averse dealer we model as being debt financed, also very much in line with what's out there in the real world. That basically, when a dealer wants to finance a position and wants to expand the balance sheet, the dealer needs to finance itself with debt. And the dealer is a mean variance optimizer, as in a recent paper by Foucault et al. Now, when it comes to the liquidity demand, it's relatively straightforward and symmetric how we model this. So there is a L unit mass of liquidity traders in each pair, and at the outset there are some of them that are buyers in the currency X, where we then have a fraction greater than half, which of them are buyers, and then symmetrically the same fraction being sellers of the Y currency, whereas then for the currency pair Z, we don't have an imbalance. So there is an equal amount of buyers and sellers. You see here below in equation 8 is the utility function of the dealer. I should say that the dealer maximizes the expected profits from its own position. So the positions of the dealer are given by Q, and they consist essentially of taking advantage of the price dislocations and also extracting the bid-ask spreads, while at the same time these positions come at a cost because the dealer needs to finance itself with debt, as I mentioned before. And so this debt financing cost is given by the delta parameter versus gamma here measures dealer leverage. And then there is a disutility that comes from expanding the balance sheet, which is essentially captured through this variance term multiplied by the risk aversion coefficient over 2. Now, what we can do is we can derive the supply function for the dealer. It's quite intuitive, but I think in the interest of time, I think I should probably hurry up a little bit and move to this equation here. So once we have established the market clearing, we can solve for the different prices, in particular the mid quotes, and then the bid-ask prices as well. What is important is that in this model we can get price distortions. So the price being the actual price, the mid quote being driven away from the fundamental value E. And this arises because of the liquidity traders pushing away the price from fundamentals, but it also arises because of the risk-averse dealers that don't expand the balance sheet infinitely to take advantage of these mispricing. So there is some mispricing that can persist. And so based on this model, I think there are two main propositions that I would like to highlight and that I would like to give you some intuition on. The first is that this price inefficiency metric PIM that we have empirically and that we can also analyze theoretically in the model, that it tends to rise when volatility of the exchange rates goes up. So this is what you can see here on the left-hand side. And the effect comes mostly from the rise in the transaction cost. That also empirically turned out to be the most important effect. Now, however, on the right-hand side, you see then the effect of the eta variable. Eta is the amalgam of the dealer's funding cost of debt and the leverage. And so we generally see also when that dealer constraint variable eta goes up, we see a deterioration in the PIM variable. And it's mostly coming from the rise in the transaction cost. Whereas the impact actually on D-loop tends to decrease when eta goes up. And it's interesting to ask yourself where that's coming from. This latter effect, It essentially comes from the effect that whenever the dealer constraint rises, the dealer posts more conservative bid-ask spreads, which is reflected in the rise in T cost. But that also in turn means that the traded volume overall decreases. And so we have essentially a less distorted demand imbalance for the dealer, and hence overall D loop, so the price distortion is alleviated. And then the second key proposition is captured by this graph here. And it states that dealer intermediated volume is overall positively correlated with PIM. And as I said before, this correlation we refer to as the elasticity of liquidity provision. But now when we're moving from a state where the dealer is unconstrained, which is captured by the light gray here, to a state where the dealer is more constrained, what we see is that the tangent line essentially becomes flatter. So in essence, what it means is that the volume, when PIM rises, that essentially the intermediated volume rises at a slower pace in states when the dealer is more constrained. And this is what we mean by the elasticity of liquidity provision weakening when the dealer is more constrained. Very similar to what we find empirically in the data. So I think in the interest of time, I should probably wrap up. So let me just conclude then. This paper made the case that even in very large liquid asset markets like the FX spot market, dealer constraints can have a very significant impact on market efficiency. Dealers support market efficiency in normal times by providing immediacy to their clients. They do so by channeling volume to these clients. And so intermediated volume tends to rise whenever there is an inefficiency. But when we see tightening of dealer constraints, then this relationship between dealer intermediate volume and price inefficiency breaks down and weakens. Let me stop here. Thank you very much. Happy to take questions.
Thanks. That was really interesting. I really like the distinction between the sort of marginal, the elasticity versus the sort of there's average more liquidity provision on average, but the marginal was really key. There was an early question that I sort of answered on my own initiative, but I think it's a good question, which is sort of, this is a very FX focused paper in some sense, but there was a question about, how broad would these about the breadth and relevance of these findings, so maybe other markets at the moment. I was wondering also, are these the same dealers who are intermediating a lot of the other markets have talked about being disrupted, doing dash for cash, et cetera, et cetera. So perhaps you could speak to sort of the broader relevance of the paper.
Mm-hmm. Yeah, absolutely. You're absolutely right, Reese. Many of the dealers that we're talking about, they are the usual suspects. They would show up very prominently in the GSIB list, for example. So they would also be making markets in a lot of the derivatives, interest rate swaps, typically, or FX derivatives as well. Same for the cash bond market in particular, or corporate bond market. So I believe that these results in general would apply also beyond the FX spot market. Clearly, this is the case, for the theory. So I guess the theory could be easily adopted to capture, relative value relationships also between related assets that are not FX. Obviously, we focused on the triangular arbitrage in the spot market because it's also a relatively easy no arbitrage condition to analyze. But yes, one could think about quite a few other applications. Like one that comes to my mind would be to study, let's say, on the run versus off the run bonds, or it could be also to study deviations of government bond prices from yields from that of a smooth yield curve, for example. So I think that's clearly possible. We didn't do it in the paper, but yeah, future work could shed light on it.
Yeah, I guess a follow up on that is that, like, I can see the sort of the broader relevance, but I'm always struck that often these papers will focus on one market, whereas there seems to be a bit of identification available. If you say, well, if it is the dealers that are driving it, if my story is the dealers, I should see it in multiple markets simultaneously. So it seems like almost these papers almost like do themselves a disservice by narrowing down to one market, and maybe you could get a bit more identification by saying, well, any argument on endogeneity I can reject by showing it's also present in two markets and sort of compare them. Anyway, there was another question. I think, David, you've activated your camera. You're ready to ask?
Yeah, Andreas, lovely paper and very nice presentation. So my question was going to be about the policy side of this, where in particular there was a relaxation of the leverage ratio constraints, as you know, with the removal of reserves, I guess in 2020. This happened in the UK as well in 2016, 2017. And I was wondering if these, you can kind of see the impact of these types of events in ameliorating the inefficiency you describe.
Mm-hmm. Yeah, that's a good question. We haven't looked specifically at these in events, but in other work we did. So I mean, this was in the context of covered interest parity deviations, where we didn't find an important effect of the removal, of reserves in particular in the leverage ratio calculations on covered interest parity deviations. I think that's something we should definitely, in the case of spot effects, look into a little bit more, whether it played a significant role. So this is just based on market intelligence and speaking to dealers, etc., hearing what was happening around the time. So my sense is that it was less regulatory constraints that were binding at that time, but rather it was internal risk constraints by banks that were binding at the time. And this is also supported by the fact that still most of the dealers were operating with relatively high headroom with regard to the regulatory minima. So yes, it seems to me that it's more these VAR type constraints, funding constraints, etc., that were more relevant than the regulation driven ones. But it's also very difficult to fully disentangle these factors, I should also admit.
That's super interesting. And one more tiny question. You had these intriguing results where you showed that the tightening of constraints was different for banks versus non-banks. Do you have like a story for what's going on in driving those results? I found that very interesting.
Yeah, so it's difficult to fully rationalize it. I must say there could be perhaps a bit of a relationship element. I was thinking, that in particular the corporates, large asset managers, etc. Dealers would be quite wary to lose them as a client, and so they'd rather keep making markets and so on for these clients, whereas the transactions with other banks, maybe a bit the risk management. I guess these flows would be more risk management driven transactions with other banks, or also the banks being possible arbitrageurs as well of the triangular arbitrage. That volume then sort of is less supported in these constraint periods. But I'm afraid this is very difficult to fully underpin. But that would be my hunch.
I found that interesting as well. I mean, I had this idea of the both banks maybe both being affected by the regulatory things, and you end up with this multiplication of like the Harbinger triangles, the inefficiency things. but I also had a flavour of the inefficiencies sort of compounding each other. Actually, just quickly, because we'll have to stop soon. Simon Jokartis, the Bank of England, actually has a paper specifically, I think, related to that sort of the story you just told about reputation and relationship with non-bank. I think it's Simon Jokartis. So possibly, if you know him, or you could reach out to him. But he's a good guy as well. That was a real pleasure, Andreas. It's a really nice paper, some really interesting empirics, and a very clean framework to think about it. Right, thank you everybody for attending. Andreas, as I say, it's going to end quite abruptly now, but I will reach out. I'd love to chat to you a little bit more. And Fabricius, I don't know how to pronounce his name. Fabricius.
Yeah, that's perfect. Okay.
Cool, yeah, really nice to have you involved as well. Cool. All right, guys. Enjoy the rest of your meetings. I've got a few as well, but I'll be in touch.
Thank you very much.
Thank you very much.
Really interesting work.
Thank you.
It is. I'll see you in a minute.
Bye.
Bye.